Hey, Adam Hooksema here from ProjectionHub, and in this video, I'm going to be walking you through how to acquire an assisted living facility business with an SBA loan. I'm going to really be focused on the financial aspects of an acquisition of this type of business and how an SBA lender would look at a deal like this. So not really diving into the complexities of the licensing and staffing requirements of the business and that sort of thing, but really focus on the financial side and just looking at how would an SBA lender determine whether they would be willing to make a loan on a business like this. And hopefully this will be helpful for you as you're looking at potentially acquiring your own assisted living facility. So with that, I'm going to put a link in the description of the video below to this template that we're using. This is our acquisition projection template. So you'll be able to grab that and utilize that for your deal. And then if you have questions about a deal that you're looking at, feel free to reach out. You can reach us at support@projectionhub.com, and we'd be happy to have a conversation with you. I guess before I dive in any further into the deal here that we're looking at, just a little bit of my background. I was an SBA lender for 12 years, closed about 1,500 loans, and now I own ProjectionHub, where we help folks through the process of acquiring businesses with SBA loans. We help do the financial projection and business planning process and help connecting them with the right lenders that are going to be able to get their deal done. So this example here is kind of based roughly on a client that we worked with. I've changed the numbers quite a bit, so it's not quite the actual business, but the idea is going to be similar to a business that we actually help. So this was an assisted living facility. Okay, so where I'm starting here is our at a glance tab. This is kind of a high level of the projections that we help create for this client. And you can see that you get a 5-year income statement summary, 5-year cash flow, 5-year balance sheet, and then income statement, cash flow, and balance sheet broken down by month for each of the 5 years. So that's what a lender is going to ultimately need. But before we even get to projections on a deal, really the lender is going to be focused on the historic financial situation, the historic financials of the business. And so typically we start with the last 3 years of tax returns. So in this particular case that we were working on, the business had actually been declining. The revenue had been declining, it had been kind of mismanaged. And so the new buyer was coming in and hoping to turn that around. And they had experience of actually doing that and operating turnarounds in the past. And so we had a good case to make, but we needed to show that the numbers could work. And so we got the historical financials in here. The big thing that you'll note is this right here, this rent expense. So they were paying a bunch in rent. And with that, you see this big negative net income, right? So this negative taxable income. But we had a number of add backs. So what we said, there was actually a management company in there that is going to go away after the new buyer came in. So we could add back the cost of the management fees of $191,000. The seller was taking a salary here. That is going to go away, so we could add that back. And then in this proposed deal, the buyer's going to buy the building. And so because they're going to buy the building, they could add back the rent. They're not going to have that rent expense, or they'd just be paying rent to themselves because they would own the building. So we could add that back as well. And then we could also, we also needed to have a negative add back here for the new owner who was going to take some compensation. So we're saying $10,000 a month or $120,000 a year. And they were also going to hire a new sales and marketing person to be able to help turn the revenue decline around. So based on that, we ended up getting our seller's discretionary earnings. And we could also add back depreciation here as well to come up with our estimated cash flow available for debt service. So this is what the lender is going to be focused on. How much cash flow could be utilized to pay towards the loan, right? And then what we needed to do is come in here and put in a proposed loan amount and terms. And so in this case, the asking price was effectively just the value of the real estate because the operating business had been deteriorating, but the building itself, had some value. So we were looking at a $2.3 million loan and a 9.5% interest rate over a 300-month term because the purchase was including the purchase of real estate. So typically If you're just buying an operating business, you're going to have an SBA loan on a 10-year term, so 120 months. But if you're buying real estate, and if over 50% or 51% of the purchase of the acquisition is for real estate, then you can put the whole loan on a 25-year term, which really helps from a cash flow perspective. It spreads out that loan payment. So in this case, we were going to be able to do a 25-year term, and then the buyers were going to put in $500,000 of equity, which was, above and beyond the kind of typical 10% requirement. Usually an acquisition deal, SBA lenders require 10% down payment. But because this business had been deteriorating, the lender was saying, hey, we want some more equity in this deal. So that's why we had the buyer putting in more equity here. But based on this loan amount and interest rate and terms, we can see this proposed annual debt service. So for that loan, you'd have debt service or loan payments of $241,000 a year. And then the lender is going to calculate debt service coverage ratio here, which is taking the estimated cash flow, dividing by the proposed annual debt service. So you can see a few years ago, they had $4.18 of cash flow for every dollar of loan payments. So that's great. That's really strong. No problem. Typically an SBA lender wants you to be at 1.25 or above. So a debt service coverage ratio of 1.25 or above. But in this situation, the lender is really going to kind of stick at that 2.3 million. They were not going to be willing to lend more because we can see this trend, pretty ugly trend. So we had DSCR 4.18, then went down to 2, now down to 1.79 in the most recent year. And so because of that, if the trend had been positive and the business had been growing, a 1.79 debt service coverage ratio would be really strong, really great. But the lender's concern here is going to be, hey, does this go from 1.79 down to 1.5, down to 1.2, and they're making a 25-year term loan, right? So they want a margin of safety. So it really is going to depend, your deal is going to depend on the trend, right? And so the lender in this case was willing to kind of close their eyes and they weren't closing their eyes, but to turn and get comfortable with this declining trend because the buyer had a strong experience of turnarounds and they had a margin of safety here at a 1.79 debt service coverage ratio. That could give the buyer some time to turn it around, even if it continued to dip in the first year post-acquisition. They still had some room. So that's the way a lender is going to look at a deal. They're going to look at the last 3 years. They're going to look at debt service coverage ratio, and then they're going to look at your plan going forward. But this is kind of the first step is let's look at historical cash flow. And then what we are typically doing at this stage, if we help you kind of go through this process and see how you cash flow historically, we try to find a lender who's willing to give you a term sheet. And then with that term sheet, you can say, okay, now I know what I should be able to borrow. And if you can make that deal, that structure work with your seller, then you can move on to underwriting and try to get a full approval from the lender. And when you're going into underwriting, that's when you're going to need the full projections going forward. So that's where we start to dive into, here's what our projections are going to look like. And we kind of go through line by line and say, here's our assumption. This expense is going away once we take over. This expense is going to change. Here's how it's going to change and why. And ultimately that drives your projections going forward. In this case, with their turnaround planned, they were going to, improve debt service coverage ratio back up to 3.67 in the first year, really with a strong plan. That's kind of the way a lender is going to look at a set of financials on a deal like this. And this is a little bit of a unique case since it was a turnaround. But yeah, if you have a deal that you're looking at and you want to just have a conversation about it, feel free to reach out. You can reach me at support@ProjectionHub.com. Be happy to have a conversation, take a look at your deal, see how maybe an SBA lender would view the deal and give you some feedback on that, and try to help you figure out how to make a deal get done. So if you have any questions, don't hesitate to reach out. And if you found this video to be helpful, it'd be great if you subscribe and like the video so you can see our other content on SBA lending and acquisition. So we appreciate it. Thanks.